Financial services can be described as the oil that lubricates the mechanisms of our economic structure. Starting a business, buying a home, funding a once-in-a-lifetime event such as a wedding, or tiding you over until payday, they can be a great way to have real wealth now and pay for it with money later. At the heart of financial services pricing is interest rates. The universal way to display this fee is in an annual equivalent rate, or AER. This isn't always a reflection of the true cost of the service rendered. The best example of this is with payday loans. Because a payday loan is designed to be repaid within 1 month, the AER, which lenders are obligated to display, is very high. But as you repay it within a matter of weeks, not years, it can be more helpful to look at the gross repayment amount. Credit cards typically have the advantage of an interest-free period, usually 1 month on an ongoing basis, or a set period from when you got your credit card. And as long as you repay the balance within this time frame, the credit will cost you nothing in interest. However, if you fail to repay in this time, the interest rates can be higher than a normal cash loan. Mortgages are typically repaid over decades, so the AER is compounded, meaning that it is usually applied to the total balance, including the interest already racked up. This is why the AER is typically lower the longer the repayment period, as the total interest amounted will increase over time, and you'll have interest on your interest. Perhaps this is why the true meaning of mortgage is derived from a French word meaning death pledge. The economic reasoning is that if you give someone a home and demand that they repay it with legal currency, they will need to work for a lifetime for the good of society in order to pay for it. Although considering that to build a home single-handedly would probably be a lifetime's work, don't feel too bad about it. The interest rate you will pay will be determined not only by the type of loan you choose to take out, but also by the following parameters: the risk you fail to keep up with the repayments, the amount of time you need to repay your loan, and how much you place down as a deposit. It is your credit rating score and the deposit you have available that determines the risk you will fail to repay. For example, if it is deemed that there is a 1 in 10 chance you will fail to repay your loan, credit card or mortgage, your lender will need to charge at least 10% total interest, so that 9 repaid loans with interest cover the cost of 1 loan never repaid. Over a 2-year period, this would be an AER of roughly 5%, while over a 6-month period, it would be an AER of 20%, but the total interest of 10% would remain as a gross figure. Now that you have a deeper understanding of how financial services are priced, you can be better equipped to take out the right kind of loan for you. Try out our savings calculator and other useful videos on the Reduce My website, part of the Helping Our Future charity.